So what's up, guys? My name is Irvin Lopez. Thanks for coming today. It's going to be a not the longest webinar, but it gives you a quick idea of what bridge loans are. If you have any type of consumers or sellers that are on the fence and have tons of equity or have their house paid off cash and indirectly want to buy their buy their up leg without selling contingent. So that's what this opportunity does with called a bridge loan or a bridge to sell. Obviously, with baby boomers are the ones that have the most equity, or they have it, or they have the majority of their houses paid cash if it's their primary investment, second home, vacation home, or things of that matter. So the intention is it's a bridge loan to sell to buy the next property. So example, if they own a property, $1 million cash, if they have equity and they owe it free and clear and they want to buy the next property, they're looking at downsize as a case and example, $500,000 cash, you can take that bridge to buy that next property non-contingent, but I'll get into it in a little bit more detail. And hold on a second. So briefly, I'm going to talk about what is contingent versus non-contingent. For those of us on here that don't know what that is, we'll go briefly what bridge loans are and two different type of products of bridge loans, which is our home light and arrival. Just to give you an idea, there are different type of bridge loans out there, depending on the criteria. The bigger thing is always credit score is king and obviously equity. But feel free to reach out at the end with any questions specifically. I will go through the slides a lot quicker, but I will stop for Q&A because we're also recording this to repurpose this on YouTube. So obviously most of you guys know me on here. If you don't, feel free to follow me on Instagram. I just started my YouTube page. So Gian has also helped me out with that. So hopefully to get some more long form on that. So what I want to just briefly explain to you guys, contingent versus non-contingent. Contingent is when you typically will, on a vanilla example, is when you sell your current property that you currently live in, and you want to wait until you have that equity, and that is sold in order to buy your next property. In the Southern California market with the low inventory market, we're seeing a lot of cash offers. So what alternative investors are offering is like, hey, you don't have to sell your current primary house right now. We'll let you buy the new property cash, right? And the way we do that is we give you a certain amount or percentage of your equity to buy that on that next property cash so you can buy it non-contingent. So that's essentially what that means, is that you can remove risky, but you can remove the inspection contingency. Obviously, if you're buying it cash, you're not really as worried about the appraisal contingency. And obviously, if you're buying it cash, there would be no loan. So the one thing to put out there, offering it with no inspection is risky. But if you feel comfortable with it, and it depends on how bad you actually want the property, it may make your offer legitimately compete with the other cash offers that are out there. So it will give you an edge, so you don't have to be pending on selling your primary residence or your current residence where your equity is trapped. And the reason is because it's the solution to a very low inventory market right now that is happening. I'm giving Southern California an example, but I am seeing a lot of markets across the country that have the same challenge, and homeowners or investors not be able to use their equity because it is untapped and it is stuck with the current home. So that's where we get to what's called a bridge loan or a bridge to sell loan. Typically, it is for primary residences. It's the cookie cutter way to do it. There is ways to do it for your investment property or your vacation homes. So the intention is, an easier one is that you typically, when you, in case an example, let's say you need a bridge loan to buy the next property. or $500,000 cash. You do not have to make payments on that bridge loan until you sell your primary residence in this example. Okay. Let's say the interest rate is 9% on that bridge loan. You do not have to make monthly mortgage payments until your house is sold. That monthly mortgage payment will be accrued. So for example, let's say you have a mortgage payment that would be on the bridge that is, let's just give you round numbers, $3,000 a month. Until you sell that primary residence, you will not have to pay that monthly. But once you sell the down leg, or what's called a primary residence, that will be accrued in the payoff and it will be taken from that equity. Typically, on average, they can vary. I mean, I'm using this as an example, up to 85%, but typically, you can use the bridge loan up to $2 million on the max. So I just wanted to give it as a case and example in that regard. The intention is, depending on the type of finance you're looking for, the new property, you would want to have it financed, or we'd like to have it financed with us, Cross Country Mortgage. The bridge loan would need to close simultaneously with the primary residence, typically, not necessarily. But the big thing I want to share with you guys is that the minimum credit score does need to be 680 in that retrospective. So credit is king. If you have a higher credit score, your terms will always be easier in that retrospect. And with that, the intention is to unlock the equity from your current home. Typically, it's 75% of your home value of the departing residence. The intention is, if you are taking a loan on the new property, you may or may not be, we can omit the mortgage liabilities, the mortgage payment that you currently have on the departing residence, and whatever mortgage you may have on your new property, or what is also called the replacement property, until your home is sold on what is considered the departing residence. And this is just one option of the program. And there's another program, it's called the Arrival. This means where you can cross collateralize your home. Bridge loan, it's another type of bridge loan, I'll get onto the next line, until your new home is secured and financed. So the intention is another way to make a non-contingent offer. If you are going to take a loan out on your replacement property or your new property, there will be no prepayment penalty, and the loan can be finance up to 100% loan to value or more of the purchase price, depending on how much equity you currently actually have. So this is an example of the cross collateralization program. So I'm going to use it as, for example, let's say your current residence is at 1.5 million. And the new property you're going to buy is going to be for 800,000. Okay. What you do is, if you add those two up, that adds up to 2.3 million. Okay. And you can take 75% of that if you're cross collateralizing with your departing residence and your new residence. Okay. So then if we take 75% of 2.3 million, we are left with 1.725. Okay. And then let's say you have on that $1.5 million property, let's say you have a $700,000 lien. So then we subtract 1.725 minus the 700,000, gets us to 1.025 in cash that will be given in the exchange of escrow. But for that intention, you can buy the replacement property above, 800,000. You can buy that cash in that regard. Again, if you have any second thoughts, and I'm getting to the Q&A part afterwards, if you have any doubts, we do offer Irvin Bucks. So we will give you $1,000 credit if there's a second opinion for any of these unique or any other type of or all loan scenarios in that regard. And at this point, I wanted to give you a gist about it, but now it's open to Q&A and more than happy to go back to specific slides. I have done the recording for my YouTube at this point, but more than happy to open it up to questions and scenarios, and I can go back to specific slides if you guys like. You guys have any questions?
Not so far.
Staff, you got any situations, Tim?
No, this is really helpful. I mean, I think it's a good conversation to just have with clients in general who don't know. Like, I just had a call with someone right now, but it was for an ADU and their house is paid off for, it's free and clear. And so this is a good conversation to talk to them about if they're, if they're thinking of upgrading or downsizing.
The one thing I do want to share, there are, depending on the credit scores, this is where like a lot of lenders don't want to really touch upon this. The cost to do the bridge loan is 1 to 2 points of the actual loan that they're going to be taking out. So if you're, depending on where the credit score is, you can, if it's depending on also the criteria and if they have other reserves, the minimum is going to be 1% of the loan amount. So if they need a bridge loan for $500,000, the minimum cost, the conveniency is going to be $5,000 for the investor, but it can go up to 2 points if they're at a higher risk or if they don't have as much equity. So 1% to 2% of that actual purchase price of the new home or what they're going to take on the bridge loan, if that makes sense. So I really, the scenarios I've run into is typically older people that want to buy cash or buy the replacement property cash. And it's typically super emotional. Like they do not want to miss out on that replacement property. Case in example, I had a older lady, 80-year-old lady, sell her $2 million house in PV, Palos Verdes, and she was moving to Arizona. She had more than plenty of equity and she wanted to buy that property in Arizona, which was in Havasu of all places, $4 million, a really nice home. But she did it like, to her paying, for her it was 1.5%, her paying the $15,000 convenience fee. It was like really a non-issue because she didn't want to miss out on that property. To make financial sense, it does make more sense to sell your house first or sell your house contingent, take that equity and go and put an offer on your next your up leg or your new replacement property. But financial sense, it doesn't make sense, but it's a tool that homeowners can actually use. But I do want to talk about that. Start rates are at 9% on the bridge loan. So again, on a $500,000, let's just say it's divided by 12. The payment would be roughly about $3,500, and they don't have to pay that monthly until it'll get accrued as a deferred payment loan once they sell the departing residence or the departing property, if that makes sense. So the intention is, if you're a real estate agent, we really, 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 really want you to have the house ready to go to market. If they take a bridge loan, once they buy the replacement property, they want it to go to market within 30 days. The intention is they don't want to get stuck on having to foreclose on the departing property. That's not something they will do or are gonna do in that regard. So it's just something to prepare your borrowers to. If you are the listing agent as well, it'd be like, hey, I'm ready to do this. But we need it, like, for all intents, if you want them to sell that departing residence within 3 months. That's my recommendation, if not sooner. Any questions?
Urban, on the that last loan you talked about, where it was like they combined the two loans,
Yeah, cross collateralization.
yeah, the cross collateralization. Um, so in that situation, they had about $1 million in equity in their current residence, right? So, um, right, because they owed about 700 grand in that house, and it was worth about 1.5, right? Is that the case?
Right. Yeah, that's the scenario I have.
So they had about 800 grand in equity there. So
Oh no, well they were gonna buy in that scenario, and I have it back up on the screen. In that scenario, their current property is worth 1.5. The replacement property they were gonna buy is 800,000. So if we add that to, it's 2.3. We take 75% of that 2.3, we get to 1.725. And then we deduct any liens that may be on the property. So the mortgage on the departing residence is 700,000. So they're left with $1 million cash. So do you have a scenario that I can run for you specifically?
gosh, not that I can really think of offhand, but okay, yeah, I was just trying to see how that works. So they, then you would pay off the first, they pay off 700 grand. Okay, so then they would have $1 million. So, but they only had 800 grand in equity originally in that first
No,
house. So,
it depends on the price of what the replacement property is going to be. So if you got like,
right, right,
so they add like the home value of the primary residence or down leg or departing residence, right? You take that
yeah,
equity, let's just say it's worth 1.5. The replacement property is 800. So then you add the 1.5 plus the 800 is 2.3. And then you take 75% of that. And that gets you to 1.725. And then you got to add the two between the current residence and the up leg or the new property that they want to buy. So you got to add that, take 75% of that, and then deduct any liens that the property may have.
got it. Okay,
I mean, it may give them the opportunity to buy cash, for example. And I'm just giving you like a very, very vanilla version of this.
yeah,
I've had it where they did this cross collateralization form for style of it or way of it, and they still had to come out with 50,000 cash of their own money to make
yeah,
this type of bridge loan work. But they had it. They have the money in reserves. Like they had
got it.
excellent credit score. They just didn't want to liquidate their reserves or their retirement funds to buy the next property cash. According to the conversation they had with their financial advisor, it made more sense for them to whatchamacallit, you a bridge loan.
Right. Okay. All right. All right. Sounds good. Thanks.
Yeah. Any other questions, Si? Or does it kind of make sense? Or do you have a scenario you want to run by?
No, I'm just listening and trying to see how this could apply in the future. Um, I didn't know about this bridge loan, so this is great information. I may I may digest it a little bit and have some questions for you later.
Yeah. It's you where you seeing it more prevalent is you're seeing they have to have tons of equity or the house like, paid free and clear. Two, if they have a loan on the current property that they're departing, still need tons of equity, but they're probably going to downsize to a smaller home.
So, is there a minimum equity that needs to be in the home prior to applying for a bridge loan?
Typically it's 75% of the appraised value.
Oh wow,
So, I mean, I would like you got to have at least 75, 80% of the appraised value.
got it.
You
Okay.
can do it up to 80, but the rates just get a little bit higher, get a little bit steep.
Okay.
Not steep, but it's like you go from a 9% to a 10%, you know? And then you got that deferred interest payment until you sell the departing residence. If they're smart about it, they have the house ready to list and they found their replacement property that they want to put the bridge loan on or pay quote unquote cash and, put in a cash offer. So then like the departing residents, they'll be able to unload it within 30 to 60 days at the max. That's ideal.
Okay.
Yeah. All right, gentlemen. Any other last takers? Thanks again for hopping on. I just wanted to give everyone a quick idea of what a bridge loan is. A lot of people aren't explaining it thoroughly.
Yeah, if you don't mind sending me a copy of the video, that'd be great.
Oh yeah, no worries. Tim,
Yeah, thanks, Urban.
thanks, man. Thanks for hopping on.
No, good to see you. Thank you.
Appreciate you guys.
All righty.
All right,
All right.
fellas.